Ladies and gentlemen, welcome to another episode of Boss Economics World with Jerome, too strong to quit, Powell at the helm. Now, today's featured spectacle. The Federal Reserve's fight to maintain its independence while feeling the heat from none other than Donald Trump, freshly re-elected and ready to double down on his heavy-handed economic policies. Looks like the next couple of years in U.S. monetary policy will be anything but quiet. But you know what? When we dive deeper into such stories, it becomes really clear. There's more to the seeming drama between Trump and Powell than just big egos and political tension. Below the surface, it's a microcosm of the immense dysfunction facing America's economic management right now. Now, let's break this down like tomorrow's coffee prices depend on it. Because this saga isn't just about two individuals. It's about inflation, employment, interest rates, the US dollar, international competitiveness, and most importantly, how the decisions coming out of Washington, D.C., whether in the Oval Office or at the Federal Reserve, are slowly eroding financial stability and possibly pushing us toward one of the most severe recessions in modern history. Let's start from the top. Jerome Powell sitting firmly in his seat as chair of the Federal Reserve while dodging demands from President Trump to step down, who thought economic policymaking could turn into a Hollywood blockbuster. Imagine the tension. Trump, who's already won a second term with an unexpectedly large margin, charging in with his aggressive pro-growth, pro-tariff playbook. And who's stopping him from running full steam ahead? The independent institution tasked with managing the nation's money supply, Powell and the Federal Reserve. Now here's your takeaway from this first scene of the economic action drama. The Fed is trying to stay independent, but in reality, Trump's re-election could throw a wrench into how effectively Powell and his team respond to economic challenges. But let's be real, this isn't just about who holds the gavel. This conflict taps into several burning economic problems that involve the politicization of monetary policy, threats to financial stability, and inflation risk. The Fed's central mandate is simple in theory: maximize employment and keep prices stable. But how do you achieve that when you've got the president openly scrutinizing rate hikes and cuts like it's a reality TV show? Trump's entire first term was marked by constant badgering of Powell, calling for relentless rate cuts to juice up the economy, enhance consumer spending, and keep stock market valuations soaring. Only, lowering interest rates while your economy faces inflationary pressures is a dangerous mix. Just imagine, during the Trump administration's first go-round, every time the Fed even thought about raising interest rates, Trump tweeted, "Jerome Powell doesn't know what he's doing, let's cut rates." Raising rates too fast or too high could pop asset bubbles, but cutting rates too far while ignoring inflation could cause long-term damage. And that's exactly the road we seem headed toward, given the continuation of Trump's ultra-expansionist fiscal policies. Here's the first critical lesson for the audience: true central bank independence is more of a myth than we want to believe. The constant political pressure from the executive branch on the Fed shows how tricky it's become to practice responsible monetary policy that doesn't cater to short-term political gains. Remember, presidents want re-election, they don't care what happens in the bond market 5 years from now. Now on to one of our most critical subjects, interest rates and how interest rate manipulation is distorting the economy. For years now, low to negative real interest rates have fueled a firestorm of unintended consequences, mainly by creating cheap money, which has supercharged corporate debt, housing bubbles, and high asset inflation. Powell and his team get this. They understand the risks of cutting rates too quickly and too often in the middle of unstable economic conditions. It's a short-term sugar rush for the economy. But what people forget is that easy money policies eventually lead to harder problems, namely inflation ballooning and bubbles forming in risky assets like tech stocks, cryptocurrencies, and housing. Sound familiar? Look at the housing market today. Affordable housing? Forget it. The ultra-low rates of the past few years have driven up home prices through the roof, or should I say, to the moon, because honestly, that's where today's home prices seem to be targeted. Remember, cutting rates gives institutions more lending capacity, which in turn drives consumer spending. More demand, fewer houses, so prices jump. How much longer can we sustain this hot housing market before people realize that American homes are becoming luxury products only the rich can afford? It's wild. But as Trump re-escalates his demands for more rate cuts, we must ask, are we walking into another 2008 crisis, where cheap credit and reckless lending come home to roost? Okay, next up on our clear decision needed list, trade wars. Oh yes, this is Trump's claim to fame. Remember those aggressive tariffs and America First economic policies? Well, they're making a comeback. Trump's second term promises more tariffs on Chinese goods, more aggressive taxation of imports, and even stricter immigration restrictions. Good for domestic jobs, right? Maybe in the short run it'll spur job creation in key industries, but the long-term costs include higher consumer prices, weaker manufacturing output, and increased strain on global supply chains. Case in point, prices of consumer goods. While tariffs may boost local production, marginally, they also end up pushing the cost of final goods up for Americans, because components of these products are often sourced globally. This contributes to inflation, something the Fed directly manages through monetary policy. So, as Trump ramps up the domestic agenda of boosting manufacturing through tariffs, transportation bottlenecks and material shortages keep pushing prices higher. Let's be honest, when was the last time you bought a cheap TV made in America? Economist after economist has warned against Trump's tariff strategies. Ben Bernanke, former chair of the Fed, warned back in 2018 about the direct link between tariffs and slowing growth. The tighter noose around global commerce chokes global productivity, and in turn, the US sees its own efficiency fall behind. Not to mention, market volatility increases due to supply-side uncertainty. Again, Powell gets it. He's confirmed that fiscal policy plays a significant role in influencing the Fed's interest decisions, but Trump isn't the type to sit back and swallow tough love from the Fed. That leads us straight into the inflation discussion, folks. Inflation isn't just around the corner, it's already in the house. Look at September's reading, higher than expected, with CPI edging dangerously close to levels last seen during the 1980s inflationary period that Paul Volcker had to crush with massive rate hikes. We've got surging prices for essentials like food and housing outpacing wage growth. Powell himself noted that economy-wide demand is stronger than initially anticipated, compounding inflation risks. But what's Trump's move here? More easy credit, more short-term tax cuts, and fewer trade constraints. Ladies and gents, this is a recipe for stagflation, a toxic combination of high inflation and stagnant economic growth. Now, raise your hand if you've lived through the misery of the 1970s stagflation nightmare. It ain't pretty. Now comes the catch-22. Powell hinted at the Fed slowing down or possibly pausing rate cuts come December, but honestly, who could blame him? Faced with constant political interference, Powell's future decisions might gravitate toward keeping rates lower for longer to avoid painting a bullseye on the Fed's back. The problem is, as the Fed takes baby steps toward normalization, the distortions created by low rates don't just disappear, they further grow into monstrous bubbles. Take corporate debt, for instance. Corporate America is buried in debt. In September 2023 alone, debt-to-GDP ratios hit record levels, indicating just how leveraged companies are right now, powering stock buybacks and dividends despite sluggish revenues. And how did they manage this? Cheap debt made possible by Powell's predecessor Janet Yellen and then Powell during the pandemic. The longer rates remain low, the more dangerous this debt load becomes when the music eventually stops. In conclusion, what do we have here? Two major forces, the White House and the Fed, on a collision course. Trump won't back down, and Powell, for the sake of preserving what's left of Fed independence, cannot afford to give in to political whims. The result of this tug-of-war? A tug-of-war that bleeds into market instability, economic uncertainty, and quite possibly a major correction for businesses and households alike. You may think we're already deep into uncharted waters with interest rate policies and inflationary pressures. But truthfully, we're just getting started. When you think about the next couple years of Trump 2.0 versus Powell the Strong, brace yourselves for a volatile mix of more aggressive fiscal policies, ultra-low interest rates distorting market values, and a Federal Reserve almost guaranteed to struggle with its internal consistency while it battles external pressure. It's like watching a boxing match, but instead of punches, they're throwing trade tariffs, interest rate hikes, and pieces of dollar depreciation at each other, while the rest of us average citizens and businesses get clocked in the crossfire. So, what can we expect? Let's dive deeper into the potential impacts and trade-offs, and see how this power struggle at the top could ultimately affect you, your business, and, more widely, the US and even global economy. To really grasp where all this leads, we must first ask ourselves, what does a more politically charged Federal Reserve look like? Historically, when political pressure compromises central bank independence, we see a skew toward policies that prioritize short-term gains over long-term stability. In Trump's case, the outward demands for lower interest rates are made with the intent of boosting economic growth, spurring consumer spending, and keeping financial markets buoyant. However, as mentioned earlier, these could very well be temporary highs with lasting negative consequences. Here's the thing, low rates are great for consumers in the short term. More house buying, more borrowing, more spending. But what happens over time? Overextension. Companies and individuals stretch their finances to a near breaking point. Meanwhile, an overheated economy sparks inflation, leaving policymakers scrambling to regain control before things spiral further out of reach. Consider Japan in the 1990s, when an extended low-interest environment led to the infamous asset bubble collapse. Once that bubble popped, the country fell into decades of deflation and stagnation, leaving its economy to struggle to this very day. The U.S., with its mounting national debt and excessive corporate borrowing, risks following a similar path if responsible monetary policies are continuously undermined by political interests pushing the Fed to keep money cheap indefinitely. The word, inflation, is probably causing a lot of sleepless nights in the Fed's boardrooms right now. While Powell has firmly stated the importance of price stability as part of the Fed's dual mandate, inflationary pressures are rising much faster than expected, and this isn't just an abstract concept on the news, this affects real-world prices for everything that matters. We're already seeing inflation trickle through a range of sectors. September's inflation data flashing way higher than anticipated should serve as a wake-up call for policymakers. With inflation sticking around above expectations, largely stemming from pandemic-era policies like stimulus payments and supply chain bottlenecks, we've finally reached the stage where people are starting to feel the pinch in their daily lives. Rent is up, groceries are up, fuel prices are up. What's worse? Inflation erodes purchasing power for everyday Americans, especially for lower and middle-income families who are already living paycheck to paycheck. A sustained period of inflation eats away at wage gains, meaning even if salaries rise, they don't rise fast enough to keep pace with escalating costs of living. For instance, food prices in the U.S. have surged 4.5% in just the past year, USDA 2024 data, and shelter costs account for nearly 40% of core inflation. And when inflation isn't addressed early enough, it becomes exponentially harder to control later. Look at the 1970s, when the Federal Reserve had to jack up interest rates to nearly 20% to tame what was then runaway inflation. Sure, it eventually worked, but the consequence? A brutal recession. That's the road we could be marching down, ladies and gentlemen. The longer we wait to raise rates to contain inflation, the uglier the consequences will be. Inflation doesn't magically disappear on its own, and keeping rates artificially low in the face of growing inflationary pressures puts both the economy and Powell's credibility at risk. But somehow, Trump's policies of slashing taxes and raining down tariffs ignore this. Remember, tariffs are a form of taxation, they increase the cost of imported goods, meaning that consumers and businesses alike face steeper prices. The average American consumer shoulders the brunt of such cost increases, leading to an inflationary spiral. Every time you buy a washing machine or a new laptop, just remember, part of that cost comes from tariffs slapped on imported goods, most of which were direct consequences of Trump's economic campaigns of the past term, brought back for an encore. Let's unbox this tariff situation. Trump has always billed tariffs as protecting American jobs, but there's a deceptive simplicity in that argument. Sure, tariffs may protect select industries domestically, such as steel manufacturing or agriculture, but the macroeconomic picture is far more complex. Every time Trump ramps tariffs up on Chinese goods or other imported products, the global economy gets tangled in a trade war of growing proportions. This isn't 2019 anymore, supply chains now stretch even thinner post-pandemic, and a renewed trade war could cause catastrophic breakdowns in industries that depend on seamless international trade. Think cars, electronics, and retail, 80% of global trade takes place within supply chains. More tariffs equal more costly disruptions. For businesses, those higher input costs inevitably trickle down to consumers. To make things worse, inflation pushing costs higher leads to an increase in input costs on labor, goods, and services, which further exacerbates the inflationary cycle. Thus, tariffs backfire by limiting both growth and affordability. There's something economists call the elusive nature of reciprocity in trade wars. Put simply, when a country like the US imposes tariffs, other countries don't just sit by and take the hit, they retaliate. So, for every tariff Trump grants to protect American industries, countries like China, Canada, and the EU fire back. And who suffers most in the crossfire? American businesses and workers. Case in point, back in 2019 and 2020, agriculture got clobbered when China slapped tariffs on US soybean exports, a $14 billion industry, leading to an outright collapse in those markets during Trump's first trade war episode. It's a vicious cycle that Trump's re-election may well reignite, leaving us to wonder how much longer America has to be stuck in this tug of war over misguided protectionist policies. Now let's zoom out. What happens globally if the world's largest economy plays political tug of war with its Federal Reserve? The US is not an isolated bubble. Like it or not, what happens in Washington's policy circles ripples across global financial markets, fast. First, we should mention the impacts on emerging markets. Many of these countries, particularly in Latin America, Asia, and Africa, hold large portions of their debt in US dollars. Low interest rates in the US have allowed them to borrow more, fueling growth in developing economies. But if rates rise suddenly to counter inflation, things could go south quickly for these countries because a higher dollar makes it costlier for them to service their debt. History has shown us this can send developing economies into a tailspin, as we saw post-2013 during the taper tantrum, when even suggestions of rate hikes by then Fed Chair Ben Bernanke sparked debt servicing crises abroad. Then there's the impact on global capital flows. As uncertainty grows around Trump's economic agenda and ongoing monetary policy interventions, foreign investors may find U.S. markets less attractive. Breakdown in dialogue on interest rates, inflation fears, erratic fiscal policies, all of this heightens global risk aversion. If global investors pull back, capital flows reverse, stock markets could tank, and slower economic growth could spread beyond U.S. borders. Powell's steadfast commitment to Fed independence is crucial because domestic U.S. monetary policy has always functioned as a global public good. If the Fed shrinks from its role as a stable pillar, global financial instability is guaranteed to increase, and instability breeds recessionary moods everywhere. If all this economic posturing sounds like the U.S. is nearing a recession, that's because it is. A recession is not an anomaly, it's the economy's way of resetting unsustainable imbalances. The when is always the question, but we've got several red flags flashing already. Let's look at some data indicators. The Fed's favorite gauge of inflation, the Personal Consumption Expenditures, PCE, index, has remained persistently strong, with core PCE up 3.4% year-over-year, well above the Fed's 2% target. Meanwhile, growth in corporate earnings has flattened out, and an inverted yield curve, often a predictor of economic downturns, continues to flash warnings in bond markets, suggesting that investors are already bracing for rough times ahead. And let's not forget consumer sentiment, which remains fragile in the face of political uncertainty and potential interest rate hikes. Not to mention, historical comparisons show that each time inflation drifts far above target without timely intervention, we inch closer to a recessionary showdown. The combination of higher consumer prices, stagnating wage growth, uncertainties in trade policy, and weakened global demand are all forming an economic cocktail that's far too reminiscent of the 1970s-style stagflation. Add to this ongoing political discord between Trump and Powell's Fed, and we've got a recipe for economic uncertainty at best, and full-blown recession at worst. Buckle up, folks. What we're witnessing isn't just posturing by Powell or political gamesmanship by Trump. What we have is a direct confrontation between two powerful forces whose actions will echo throughout the economic system. On the one hand, Powell is defending the integrity of the Federal Reserve, committed to stable prices, maximum employment, and financial continuity. On the other, Trump is pushing for dramatic short-term stimulus policies aimed at juicing up the economy in ways that may provide immediate gains but risk long-term harm. This dynamic tension at the highest levels of economic decision-making is like a fault line that, when pressured too much, could erupt into widespread economic damage. So, where do we go from here? Let's dive into final points focused on what this really means for the average American, global markets, and future economic policy.